For many travelers, Spirit Airlines is synonymous with no-frills flying. The bright yellow planes and ultra-low fares have become a familiar sight in airports across the nation. But behind the scenes, a financial storm has been brewing. On November 18, 2024, Spirit Airlines filed for Chapter 11 bankruptcy protection, sending shockwaves through the industry and leaving travelers wondering about the future of their travel plans. This wasn't entirely unexpected. The airline has been grappling with a series of challenges, from failed mergers to mounting debt. The bankruptcy filing marks a pivotal moment for Spirit, forcing it to confront its financial woes head-on. It also serves as a stark reminder of the volatile nature of the airline industry, an industry still reeling from the aftershocks of the pandemic and facing a new set of economic headwinds. The news of Spirit's bankruptcy filing has understandably sparked concern among passengers. Will flights be cancelled? Will tickets be honoured? The airline has been quick to reassure customers that it's business as usual, at least for now. Flights will continue to operate and existing tickets and loyalty programs remain valid, but the long-term impact of the bankruptcy filing on passengers remains to be seen. Spirit Airlines built its business on the promise of ultra-low fares. By stripping away traditional amenities and charging extra for everything from seat selection to carry-on bags, Spirit made air travel accessible to a wider range of budget-conscious consumers. This no-frills model proved wildly popular, propelling Spirit's rapid growth and forcing legacy carriers to adapt. But the success of the ultra-low-cost model has also been its Achilles heel. Operating on razor-thin margins leaves little room for error, and Spirit has found itself increasingly vulnerable to external shocks. The COVID-19 pandemic delivered a devastating blow to the entire airline industry, but ultra-low-cost carriers like Spirit, which rely heavily on leisure travel, were hit particularly hard. Moreover, the competitive landscape of the airline industry has intensified. Legacy carriers, feeling the pressure from Spirit and other low-cost competitors, have become increasingly aggressive in their pricing strategies. This has squeezed Spirit's already tight margins, making it difficult for the airline to maintain profitability. In an attempt to shore up its financial position and navigate the turbulent industry landscape, Spirit sought solace in mergers. However, these attempts proved unsuccessful, further exacerbating the airline's woes. The first blow came with the collapse of a proposed merger with Frontier Airlines, another major player in the ultra-low-cost market. The deal, which would have created the fifth largest airline in the US, fell apart amidst concerns over regulatory hurdles and antitrust issues. Adding salt to the wound, the US Department of Justice blocked a subsequent $3.8 billion merger with JetBlue Airways. The DOJ argued that the merger would stifle competition and ultimately harm consumers by leading to higher fares. This decision dealt a significant blow to Spirit's hopes of achieving greater scale and financial stability through consolidation. These failed mergers left Spirit in a precarious position. Not only did they fail to provide the anticipated financial relief, but they also exposed the airline's vulnerability and eroded investor confidence. The collapse of these deals underscored the challenges faced by airlines seeking consolidation in an increasingly competitive and regulated market. Section 4. The weight of debt and operational headwinds. Beyond the failed mergers, Spirit Airlines was grappling with a mountain of debt, a legacy of its rapid expansion and the financial fallout from the pandemic. The airline was saddled with over $1.1 billion in secured debt, a significant portion of which was due in the next 2 years. This looming debt maturity wall placed immense pressure on Spirit's cash flow and made it difficult for the airline to invest in its fleet and operations. Adding to its woes, Spirit faced a series of operational challenges. Issues with Pratt & Whitney-geared turbofan engines, which power a significant portion of Spirit's Airbus fleet, led to grounded aircraft and costly repairs. These engine problems not only disrupted flight schedules, but also tarnished Spirit's reputation for reliability, a key selling point for budget-conscious travelers. The combined weight of these financial and operational challenges proved too much for Spirit to bear. The airline's stock price plummeted and its credit rating was downgraded to junk status, making it increasingly expensive to borrow money. With its financial options dwindling, Spirit was forced to confront the difficult reality that it could no longer service its debt and operate as a going concern. For passengers, the bankruptcy of Spirit Airlines means a lot of uncertainty. Those who have already booked flights are left wondering if their travel plans will be disrupted. Refunds and rebookings become a logistical nightmare as the airline struggles to manage its dwindling resources. Frequent flyers who have accumulated miles and rewards face the risk of losing their hard-earned benefits. The affordable travel options that Spirit provided may no longer be available, forcing budget-conscious travelers to seek alternatives. This situation also raises concerns about ticket prices across the industry, as reduced competition could lead to higher fares. The ripple effects of Spirit's financial troubles are felt far and wide, impacting not just the airline, but also the passengers who relied on its services. The bankruptcy of Spirit Airlines serves as a stark reminder that the airline industry is at a crossroads. The challenges faced by Spirit are not unique. Many airlines are grappling with similar issues of debt, operational inefficiencies, and the lingering effects of the pandemic. The industry must adapt to survive, whether through consolidation, innovation, or new business models. Airlines need to find ways to become more resilient to economic shocks and operational disruptions. This moment of crisis could also be an opportunity for the industry to rethink its approach to sustainability and customer service. The future of air travel may depend on how well airlines can navigate these turbulent times and emerge stronger on the other side. Spirit's uncertain future hangs in the balance as it navigates bankruptcy proceedings. The airline must restructure its debt and find a way to become profitable again. This could involve cost-cutting measures, asset sales, or even potential mergers with other carriers. The road ahead is fraught with challenges, but there is also a glimmer of hope. If Spirit can successfully reorganize and address its operational issues, it may yet find a path to recovery. However, the journey will not be easy, and the outcome is far from guaranteed. The fate of Spirit Airlines will be closely watched by industry analysts, competitors, and passengers alike, as it could set a precedent for how other struggling airlines might deal with similar crises in the future.